More Americans are having trouble keeping up with their mortgage payments. The Mortgage Bankers Association says in the second quarter, nearly 3.5% of mortgages were overdue by 30 days. That's up from 3.35% in the first 3 months of the year. Foreclosures, meanwhile, fell slightly during the second quarter. If more people are starting to struggle with those payments, there is little cause for comfort. My next guest is Frank Pallotta, managing partner at Loan Value Group, whose clients include mortgage owners. Frank, welcome to Bottom Line. Thanks so much for coming on.
Thanks, Mark, for having me.
You hear those figures. What's the first thing that comes to mind?
Well, we're not out of the woods yet. I mean, these numbers continue to grow.
Not by a long shot, are we?
Not by a long shot. I mean, you've got sort of the double whammy of both affordability issues with high unemployment rate, and you also have a lot of negative equity, which leads to these delinquencies.
Well, Jay Brinkman, he's the chief economist for the Mortgage Bankers Association. He said that the delinquencies in the mortgage payments reflect what he says is going on in the labor market. Americans losing their jobs, obviously, that means that they can't make their mortgage payments. That's the unemployment data. But you say there's another side to this in the home price data. Tell us about it.
That's right. There's about 11 or 12 million homes in the United States that are underwater. And the immediate reaction of a borrower not making their payment usually has to do with affordability. The borrower that continues to go through and pass delinquency and foreclosure, that's generally a question of negative equity and just the borrower that's lost their investment and decide that it's really not worth it to continue to pay.
Are the banks now taking a more measured approach to delinquent homeowners in the wake of this robo-signing controversy that we heard about?
We're seeing it. Certainly, they're a lot more careful about doing it. We saw some situations where they were foreclosing on veterans. We saw situations where they didn't have the proper documents in place. So they're a lot more deliberate, but you do have to go through the process.
Last week, the foreclosure listing firm RealtyTrac came out with some information. It said that banks are on track to repossess between 800,000 and 900,000 homes this year. That's down from 1 million homes last year. How does this affect the housing market going forward? Not to mention, the very least, the glut of homes on the market now.
Well, it is really a question of supply and demand. And one of your guests, Lori Goodman, who's been on for a while,
yes.
There's a simple math equation. There's a certain number of homes in the 30, the 60, and the 90 bucket that will eventually make it through to foreclosure. And past 60 days, the number's in excess of 80 or 90%. So all you really need to do is to look at those three buckets, and you know exactly what the shadow inventory is, and you'll know exactly what the foreclosure inventory is going to look like. So it's not going to be pretty for the next few years.
When you say the next few years, at this point, you know, there's all conversations about what could have been done and should have been done with Fannie Mae and Freddie Mac, what the federal government should have done. Talk to me about your group in specific, what you're trying to do to keep people in their homes, because the easy thing that we're finding out from a lot of people, I don't mean easy in terms of flippant, I mean easy in terms of I've got lots of other things that I have to deal with. I have negative equity in my home. I just don't want to deal with this anymore. How do you convince those people to continue to pay their mortgages and hopefully stay in their homes?
Well, it's simple. Over the many years, people really made their mortgage payments for a few reasons, but mostly the investment they made continued to grow, and you continue to help feed that investment by making your mortgage payments. Here again, we have a situation where we do have high unemployment, and people are affordability challenged. But when you start to see that the mortgage payment becomes a much higher percentage of your monthly income, you look to your investment. And the investment has really disappeared for a lot of people over the years. And not only has it disappeared, Mark, but it may not come back for more than a decade. So these borrowers are making a business decision, a financial decision, not just a decision where they decide to walk away, but they're looking at what's best for their family and saying, if this investment of mine has disappeared, not much different than a stock that's gone down in value or something else that they have, like a car that's gone down in value, they will look to abandon that investment.
How do you keep them from walking away?
Well, again, the incentive has disappeared. What we look to do is we work with a number of loan owners to help replace that negative equity. We replace the incentive that's disappeared, and you know what we've seen is a 50% lower delinquency rate.
Really?
Yeah, I mean, it's a staggeringly high number because what the program does is it employs more of behavior and incentive theory than really going after pure payments.
Frank Pallotta, Loan Value Group, joining us. Unfortunately, as you mentioned, this is a long-term story and a long-term issue, and hopefully you'll come back as soon as we can get you back to discuss this a little more. Frank, it's always good to see you. Thanks so much.